All right. Welcome, everyone. Welcome to this awesome event we are doing. I'm going to see if I can get my panelists here and share the screen with them. Are you guys here, or do I need to invite you up? I think they may not be here. So this is my first time with Zoom webinar. So give me just a minute and I will go through the participants. So here we go. We'll get them up here. They're backstage and move all the webinar. Okay, perfect. Awesome. So why don't you stick in the chat there where you're coming in from, and or if you're watching this on a recording, really happy to have you here. Okay, we've got Buck, got everybody coming in. Awesome, awesome, awesome. All right, so we'll go ahead and get started. We've got a full room here, and we're just going to jump right into it. My name is Bronson Hill. I'm the CEO of Bronson Equity. We have about 200 million in multifamily assets. We're doing deals. We have a bunch of stuff in Jacksonville, Florida we're working on. So if you're not on a deals list, you should check that out. Also check out Buck, Ken, and Michael's deal list as well, or get on their investor club. It's going to be great. So wanted to just give a quick introduction of what we're going to be going over tonight. We're going to jump right into it. We are going to do some Q&A at the end, and it's going to be awesome. So I'm super excited, super pumped about it. So we've got in the house today, we've got Ken McElroy from MC Companies. Welcome, Ken. We've got Michael Blanc from Nighthawk Equity and Buck Joffrey from The Wealth Effect. So really excited to have you guys. Welcome, welcome, welcome. And I love getting people in the room like this that are really, really smart. We can have really high-end conversations around really great topics. So this topic today is with real estate. You know, as an investor, there's a lot of confusion, right? Everybody's confused. Should I buy more? Should I hold? Should I wait? The confused mind just says to wait, but inflation is high. So what should you do with your capital? Let's talk a little bit about that. I'm just going to kind of go around. Let's start with Ken. What are you seeing right now in the market? What are you seeing from retail investors? What do you think it's important to look at right now?
Well, there's no question that things have slowed down for us. I mean, we were talking a little bit before the show. I think all of us have experienced the same thing. There's been multiple reasons, and it's been no surprise. The one being interest rates. So I'll just give you one example. We had it's called low hundreds million in escrow on a deal, and we're in due diligence, and interest rates adjusted, and it adjusted so much that our interest payment went up so much that our cash flow went down, and we had to pass. So what's happening is these interest rates. This is one thing, of course. I'm sure these gentlemen here have lots of stories like that. But expenses are up, property taxes are up, labor's up, materials are up, utilities are up. Interest rates are up, cap rates are up, and rents are up. And there's only one good thing actually on that whole list, and that's rent. So, it's a weird time, but with all of that, we're still finding cash flowing deals. That's a crazy thing. Some sellers are adjusting because they have to. The three of us here, we're pretty much underwriting similar deals the same way, and we're trying to get cash flow for our investors. And so if the cost of debt goes up, then we have to offer less on the price. And so that's what's happening right now. And so there's this push-pull going on in the market with brokers and buyers and sellers, and that's slowing things down.
Great, thanks, Ken. Michael, what are you seeing in the market today?
Yeah, it's there's three options with real estate: you can buy, hold, and sell, right? And we're seeing a little bit of a combination of that. We're selling while we're trying to buy, which doesn't make a lot of sense to the outside, but we've had such a run up in values over the last 18, 24 months that we're recognizing the returns that we had projected 5 years from now. So we're like, shoot, should we hold on to this, or should we simply return the money with a return to the investors, right? So there's people that are selling, and there's people that are selling because they're afraid of what's coming, but most have been selling because of this thing that I just mentioned. The question becomes now, should one buy, right? If you're a seller, why would you be dumb enough to buy something? And so, for example, we're selling a deal right now that one of our peers is buying from us. And like, well, who's the bigger fool here? Like, you guys are a bunch of idiots. But I'm always fascinated to see kind of what other people are seeing. And I'm generally bullish on multifamily in general. But the underwriting has changed, kind of like it did right after COVID. And I think that's what's creating the problem right now. I can't use bridge debt like I did before. Okay, maybe I can't use 12-year fixed rate debt anymore. So what debt am I going to use exactly? And how should I underwrite this? How can I try to forecast what's going to happen with interest rates, possible recession and vacancies, right? So, and then there's the expectations of sellers that Kenny just mentioned. Sellers quite haven't caught up yet to the changing market. And we saw that in in COVID as well. And it took a little while for the sellers going to go, oh, the market has changed. If I still want to sell, I'm going to have to readjust. And so on the buy side, that's what we're finding. We're having trouble finding the right kind of debt, and the seller's expectations are still what they were in March at the, basically at the height of the possible market. And so that's making buying a real challenge right now.
Right. Yeah. Buying is definitely a challenge, and people want to sell, and there's, a lot of, concerns on what people should do. Buck, what are you seeing right now? Anything you want to add?
I think the markets are volatile, right? And trying to find a new normal. And I don't think we're there yet. And as the guys have mentioned, cap rates have not, appropriately adjusted for the most part, given higher rates. They certainly have decompressed a little bit, but certainly I don't think to the level that they would need to in order to sort of, and be in parallel. So, selling in this scenario, I mean, is, as Michael alluded to, especially these properties that, we've had for 2-3 years where we have a ton of equity on, sounds like a really good idea. And we're really interested in that. The problem is that on the other end, there needs to be buyers, and there isn't nearly as many buyers as there were, 6 months ago. And why aren't there buyers? Because, as I think someone else alluded to, the lending markets are really challenging. So buyers have to make the deals work too. Fannie Freddie's got very low leverage. The private, the private lenders, you guys might have experienced their spreads from SOFR were ridiculous, and so it makes it very hard from the buying end. So, so my feeling is that, over the next year, we're going to be a net seller. But I think the issue is really about, trying to find opportunities for, when the lending markets come back, hopefully we'll be able to do more. But right now, we're kind of just feeling things out and seeing who the buy, and in terms of buying, I think I would just say that, there is always an opportunity, right? Like, it's just a matter of waiting. We used to have opportunities all the time. We just don't have opportunities right now. And it's because they're not penciling out. So I think everything's just kind of slow. And I think, I think that the market is trying to understand what the new normal will be. It's not there yet.
So it's interesting, as somebody who our group wants to buy more deals, like you were saying, it's getting harder to buy. I mean, we're having to raise, twice as much money, and, because of the LTV putting more down on a deal, and, the interest rates are higher, and then those interest rate caps are getting more expensive too. So the cash flow is just going down in a deal. Kenny, I wanted to ask you, how do you see this playing out? Obviously, it seems like the Fed is just raising rates just perpetually, continually. And is there a point where, I guess rents continue to go up because the cost of ownership goes up, but is there anything that you see where that changes? Either they stop raising rates, or it kind of stabilizes out, or valuations come down? Like, what's the natural progression of how that plays out?
Well, if I knew completely, specifically Bronson, I'd be, I would have a great couple of years ahead. But here's what I do think, because I have taken a position, and I've done that publicly on my YouTube channel, the Ken McElroy Official. And that's, I talked about a couple investor blind spots in 2 videos that I think are really important. One of them has to do with this. And if you look at Powell, the chairman, he's been really clear that their target is 2%. He's been super clear. That's been his narrative every single time, even the recent one in Jackson Hole that he said, our target's 2% inflation. Okay, well, as you know, it got up to 9.1. Now I think it's 8.5 or 6 or something. But so it did come down a little bit, but that's been with a lot of interest rate increases, back from March all the way till recently. There's another one this month, and then there's another one in November. So I believe that we're going to see a 0.5 point to 3/4 point. I think it's 20th or 21st of September. I think if hopefully inflation comes down into the 7s, maybe, and then I think we're going to see it again in November. But it's going to take a while, as this rolled out. It's going to take a while to roll back. And that's not necessarily going to be good for people holding on to bridge debt or floating debt or anything like that. So, it's gonna slow the real estate industry way down. We're seeing it in single family, we're seeing it in our spaces, and we're seeing it across all lines. And so I think that he's willing to put the economy at risk to get that inflation, because inflation affects everyone, whereas interest rates only kind of affect, the people that are using, I guess, money, to buy things and or they're in debt.
Let me challenge that a little bit. I don't think you're wrong. I think for planning purposes, you have to assume that. Otherwise, it would be irresponsible.
Yeah.
But if you look at the pattern of the Fed over the since 2000, what happens every time there's a massive crisis and recession? What do? Right? Quantitative easing. They reduce interest rates and they print money. It's worked so well the last 20 years. Why would it not work? Right. So again, from planning perspective, I'm with you. I think it's irresponsible to assume that rates are going down, but from a practical matter, I think it's exactly what's going to happen. If there is a deeper recession, we're kind of sort of in one right now, but if a deeper one, people really start losing their jobs, I don't know. I think the Fed's going to wuss out. That's just my opinion.
Yeah, that's possible.
I think this whole the world has changed a little bit, right? And but I do think that the tone from the Fed is different, and that I'm more suspicious of them being really dovish, even if there is a recession. I think it's important, Sir John Templeton's quote that the three, the most dangerous words in the English language for an investor are that this time it's different, right?
Yeah.
And so so I think that from an underwriting standpoint, I think you really have to take the Fed at its word. I'm not saying, Michael, I completely agree with you on the pattern, but I also think that there's enough, we're talking about things that happen like COVID. I mean, what else are you going to do in COVID, right? What else are you going to do in 2008? The banks are in good shape right now. There is no fundamental, situation where, like we've had, where there was a massive injection necessarily. And so I kind of think that they are ready and willing to see some pain. Yeah. And I think that is different from before.
And just to clarify, I mean, we're just kind of having a good time with the Fed here. From an underwriting perspective, I wouldn't change anything. Like I'm with Ken and what you were saying. We're assuming interest rates in the 7, 8s, possibly 9s, right? And so when we're underwriting for a recession, that's one reason we can't buy anything right now. And on the other hand, I'm okay sitting on my hands for a little while. Frankly, I don't have a problem with it. I just observed over the years that there are people who are very conservative, and as a result, they never do any deals. And you can't be too conservative, but you can't be too aggressive. You have to be realistic, and finding that balance. That's the problem right now, right? That's the problem, because you don't want to go too far to one side.
The goalposts are moving too much right now.
That's right.
I think that you can't
so quickly.
I think that, to your point, we don't, from an acquisition standpoint, rates fundamentally being high doesn't affect our business plan, right? The idea is that, can we create the delta from buying to disposition that we need to? The only way we can feel confident about that is if we are in an environment where we have more confidence in where the goalposts are going to be.
The question follow up to that, Buck, and I guess just for all of you, inflation officially 8.5, 9.1, whatever it is officially, unofficially, it could be as high as 15 to 18%, whatever it actually is, we don't exactly know. But I mean, is it a point where they just keep raising rates, and do they raise them to, 6, 7, 8, 9 or higher percent? And does that then bring down inflation, or is that something that we still don't know? Inflation could still be high because of all this new money creation that happened. Anybody have an opinion on that?
First of all, if you look at what happened in the 80s, now it's tough to compare where we are right now with the 80s in many different respects. But one of the things we in parallel is that we had very high inflation. Now, the CPI was measured significantly differently back then, but Volcker raised the rates up to like 18% after, and it came down, then he lowered it again, and he went back up and he raised it back up again. So he was really trying to, so 18% interest. Can you imagine 18% interest right now? Like, is that what's required to get inflation under control? And here's why I think the Fed can't really do anything about inflation, because it can't raise interest rates much higher because unlike in 1982, when our debt was just under $1 trillion, now it's 30 times higher.
Exactly.
We have $30 trillion in debt. So a 3% SOFR rate, and now we're 2.25, something like that. 3%, if I looked at the numbers right, would make debt service the single biggest government expense after everything, including defense spending. So how high can we go? Can we go to 3? Yeah, we can go to 3. Can we go to 4? At what point is the debt service weight to the government so heavy that they can't go and won't go any higher, and that the wheels will come off, right? And so this is why I think the Fed can't do jack about inflation.
I had an opportunity to talk to a former Fed official who essentially said that the cap is going to be 3.5 to 4. That beyond that, there's a sovereign debt problem.
Wow,
That's interesting.
Really?
Yeah.
Yeah.
a Fed said that. Wow, that's crazy.
Or a Fed official.
Ex-Fed official.
Ex-Fed official.
Yeah.
So I have a question on this, and this came up earlier too, because coming back to multifamily. So 85% or so of debt is bridge debt that's out there. Now, a lot of this debt is starting to roll over in the next, whatever's happening now, the next 6 to 12 months, a lot of deals are selling. I know, Ken, you've been in this a very long time. What do you see? Are you seeing some people are going to go through some serious pain that are operators, or maybe they have bridge debt and they're having trouble rolling it over, or maybe the interest rate caps themselves, there could be any sort of problem with the insurance people are buying for the caps, or are you seeing any issues with that?
Yeah. I just wanted to point out when, I've been investing since 2000, actually before that on a smaller level, but on a bigger level, this is our 20th year in business. And the federal fund rate then was 6.25. So, the interest, it's just the math has to work in all aspects, right? The only thing that's happening is we've been spoiled with these low rates, and now everybody's freaking out and trying to figure out how high they're going to go. I just want to say that the market functions quite well. From 2000 to 2005 was a nice little run too. I was buying during that time with these higher rates. And so back to your question on the bridge. So yes, we've done some, obviously, as we all know on the call here, but I'll just explain it. If you're going to do a cash out refinance, you lean toward bridge because you want to capitalize on that value add that you're going to get. And the prepayment is really low with the bridge debt. So therefore, you're taking that interest rate risk for that short period of time. And then if you're buying something that doesn't necessarily have a value add, you put more of a fixed rate debt on it, but your prepayment's a lot higher, but at least you're hedging your interest rates. So the markets, as you guys have known, have had a lot of bridge debt in them over the last several years. And so I actually think this is going to be a problem for many people. And there's a couple other things. I don't think it's just a bridge debt issue. I think that it's also an equity issue. So there's a lot of equity that wants their money back. So if people that got money from big institutions, private equity, institutional equity, family office, whatever it is, that is behind that money, and I won't go into the waterfalls and how they all work, but that money is usually out 3 to 4 years, and so you have that issue where their equity partner is going to want their investment back. So they might be forcing a sale. And so that's the first trigger. And I think, like if you're partnering with a big company and they want their money back next year, they don't care. They want their money back. And then you as a sponsor is behind all of that. I think that's a big problem, especially if you have rising interest rates, because they're going to want, and so what could happen is a lot of these sponsors that use that kind of money, are sitting out there 3-4 years ago, they might not get anything other than fees from when they originally raised the capital and got the deal. And then you have the bridge debt reset. The interest rates are going to reset, so the cost of debt's higher. But the other thing that's higher, Bronson, we're seeing higher renovation costs, and we're seeing all kinds of higher things, and we're seeing higher cap rates. So depending on where you are around all of that, it could be when your property is, let's say, getting ready to market, if a cap rate goes from 4 to 5, let's say, which is not very far from what has happened, that's 20%. So you might get all of that through your NOI growth, but it might immediately be lost through that, through that cap rate going up a little bit. So you have all these factors at play. And I think that properties that don't have a lot of reserves and don't have really good relationships with their equity are going to be in trouble. So, and of course that could be property to property. It could be within the same company. It just depends on the deal, not necessarily the sponsor.
Yeah, thanks, Ken. That's great. Buck, you have something you want? Sure. Okay. Yeah, no, I think it's really interesting. There's these very inflationary factors, such as all the money that's been printed, rents are rising, but then you have all these deflationary or just disinflationary things where costs are I guess valuations are coming down. So it's interesting. So I guess in light of all this, what advice do you have to people? Because if I'm an investor, I've got 100K. Are you telling me I should invest it or should I wait? Right? Like, what do you think? Obviously, we're not giving anybody specific advice, but if you were telling
Depends on
just
the deal.
me,
Depends on the deal.
Yeah.
I mean,
Yep.
if there's an opportunity and there's distress and there's an opportunity to make the numbers work, then I definitely would not shy away from that. I think I would be suspicious of any company that was not slowing down a little bit right now, though. I think that, that it's going to be a deal to deal thing.
I think it's more important in any time before to really educate yourself a little bit more and ask some hard questions and really look at the assumptions. I mean, I've come across deals from other syndicators and they're, saying all the right things. You're like, really? How can you make this assumption or that assumption? And yes, the returns, and what I'm saying is don't just look at the returns. I can make my spreadsheet say anything I want. What's behind the assumptions, right? So debt has always been important, right? Well, what's the business plan? Does the debt actually match the business plan, right? What's the current market environment, right? We're kind of going bridge debt. We sure would love to use it, but I don't see how, right? So if someone's using bridge debt, maybe they got a cool product I don't know about. I'd like to know about it, but you have to really look at the assumptions and really ask, how is the operator mitigating various different risks that are vastly unknown? So in this kind of environment, if I'm underwriting a deal, I want multiple margins for error. So I want everything I'm doing, I want a pretty wide margin for error, which of course means that I can't buy anything, but rent growth, vacancies, interest rates, all these things I want, because I don't know. Right, because Buck was saying that the goalposts are shifting so rapidly. I don't know, so if I'm going to buy something, I need a really wide margin for error. So my advice is anyone doing a deal, multifamily or otherwise, what are the margins for error? And I like Buck, I wouldn't shy back from an investment, but I would want a margin for error bigger than probably 2 years ago.
Well, the other thing is that in terms of leverage, I mean, maybe using less leverage if there's an appetite for that, because obviously it affects return profiles as well. And we've certainly contemplated, going into opportunities with less leverage than we typically do. That's the other issue.
The one easy thing that LPs can do, I think, Bronson, is to simply pull the business plan out and ask the sponsor where they are and go through the detail. Are you here with your CapEx? Are you here with your interest rates? Where are we on the expenses? Where are we on delivering renovated units, that kind of stuff? I know, we have 6 ground up construction deals too, and we're getting our butt handed to us on construction costs, and we're 7.5% over on one deal, and that's a lot of money. It's a $60 million deal, and so we're basically sending a letter to the investors saying, hey, I mean, my partner Ross and I put the money up, so we're not cash calling anybody, but we're you have to be that kind of transparency back as a sponsor, and not all of them will be. Some of them might not even know. So you gotta. It's simply just pulling the business plan out and saying, hey, these were the assumptions. I know that they might not all be true and accurate, but you got to kind of draw a line in the sand at some point. But where are we and where are you? And just open that dialogue. One of my frustrations is a lot of our LPs, they don't ask very good questions or any questions at all. And I actually want them to. And I mean, I know these gentlemen here, and I've spoken at some of Buck's events. You know, he's out there, you know, we're out there educating our people, trying to tell them what's up. Not everyone operates that way. So I think it's important that they start asking questions on the deals that they're invested in, and then they'll get better. They'll ask better questions on the ones they're going into.
I really liked what was shared. Michael shared this, and you as well, Ken, just asking questions and really like Warren Buffett's principle of the margin of safety, right? Having a margin of safety in what you invest in. And on the construction side, it'd be interesting to see what margins of safety. Obviously, there's a little less margin to kind of start with, but there's a lot more upside too. Like in Jacksonville, currently we're buying stuff at $1,000, or excuse me, the rent is $1,000 a unit, and we're seeing like a 57% upside after a $6,000 renovation. So there's a lot of upside that just, you know, if they slow down, at least we've got some kind of margin there. Obviously, we still have some interest rate risk and other things. But Michael, what are some other things that you're seeing that you know, investors maybe should pay attention to, or that they should you know, watch out for?
You know, I think we need to talk about expectations, right? Because you know, you go in there with a business plan, and the last 24 months, it came out vastly better than we had projected. We're like geniuses. Okay, now maybe we're heading into a time where the business plan that we hatched 12 months ago may not go quite as we planned. Construction costs are higher, right? We're not doing ground up construction, but we're doing pretty heavy construction on these things, and then we have interest rates creeping up as well. So all those things are going to squeeze cash position and cash flow, right? So we're like, man, maybe the business plan is not going to go the way that we thought. And I think investors need to be flexible. I think we're all really happy when things are going better than planned, but given the environment, we may have to just, you know, lower our expectations a little bit and ask ourselves the question: where is the best place for my money right now? Okay, is it the stock market, where we're in the same place we were last year, right? Is it in cash? Well, maybe that's not bad, but we're losing 10% every single year. Right? Is that the best place? I know maybe we should put it in crypto, which is clearly an inflation hedge. And so as an investor, you can ask yourself a question: where are you going to put your money right now? And every asset class is challenged in some way. I think multifamily is going to come out ahead, but it may not match the projected returns we maybe had a year or two ago.
Buck, I know you bring a lot of economists on your show, and you're just one economist after another. With that same kind of what Michael was saying, what are some other choices, or would you say still this day, I've got money to invest, it's burning a hole in my pocket, I can wait, but at some point I need to deploy it somewhere? What are some considerations that you would look at?
Well, you know, one thing that you can sort of borrow from stock investors is this concept of volume averaging. And if you, and you know, we're talking a lot about, you know, opportunities to move on deals where we have significantly less leverage than we typically do. You know, every one of our pro formas always shows, you know, 17 to 19%. We've disposed, you know, an average of over 30% in the last 34 dispositions. But I mean, we had a lot of wind at our back too, right? So I think the challenge for me is to try to get investors on board with the idea that, hey, you know, this pro forma may not show 17% IRR. It may be closer to 11 or 12. And if we do better, then great, but we're not going to lie to you. Now, one of the challenges with investors is, I think that you know, once you start getting big returns, that's kind of what the expectation is on an ongoing basis. With real estate in particular, there's a couple things that I think to remind investors of. It's in terms of a hedge to inflation. Multifamily, it doesn't get a whole lot better than that. Maybe self-storage, where you're changing your rents, you know, once a year, as opposed to a commercial property that's got like a 10-year lease that's, you know, escalating at 2%, something like that. So I think a little bit of education is really critical, you know, and I think you should expect that from your sponsors.
Ken, I want you to talk a little bit more about rising costs, because it's affecting not only new construction, it's also affecting people, doing value add or looking at just getting labor and help. Do you see that changing if, let's say, in the next 6 months, we really start heading into a recession? Will demand just all of a sudden go down and costs are all of a sudden cheaper? Or do you think we're just kind of at a new normal now with just the cost of everything being more, labor being more, and there's really no going back to at all what we were before?
So we have 68 million in renovations right now. And we have 6 ground up projects, all in the 50 to 70 million range. And, so we're seeing, they're very different, obviously, as you can imagine, but we're not seeing the operational labor costs going down anytime soon. I'm talking about the renovation guys on that piece. We're actually still having some issues on the supply chain for things like washers and dryers and dishwashers and microwaves and paint and whatever it might be. It's month to month, project to project. It's been that way. It's kind of the new normal for us. I don't particularly see it being solved anytime soon. On the new construction side, actually things are normalizing for us a little bit more. Where we're hiring, let's say, a framing company or a drywall company or whatever. We have had some issues on getting some of those things, including cement. And so we've had delays on time. And like I said, we haven't had higher construction costs, but I mean, we have also had massive run up in value. So, the property that we're building, the one I mentioned, is 40 million more than we projected it would be. So, and now that's not realized, of course, until you sell it or refinance it or whatever, but that's the appraisal. So, so if you have the cash and you're managing it, and you're being transparent with everybody, you can say, listen, it's got up a lot more, but our costs are up a lot more too. And I think it's the same way with renovations. So, maybe what was 10,000 a door might be 12, as an example, but 12 times 1,000 units is a lot, or 2,000, dollars times 1,000 units is a lot, unless you've got it in the rent side. So I don't see it slowing down much. I think if it does, the new construction stuff, it's starting to settle down a little bit for us. But we're still having some issues on our one-off renovations.
Michael, I wanted to ask you, you help a lot of people get started doing their first deal, kind of getting going. A lot of people are either operators or interested in being operators. Maybe they are listening to this or watching. I guess if somebody's new, how have things changed when it comes to your approach? If you're trying to find deals or you're trying to raise money, how are you seeing that, especially for people that are new, kind of getting going in this?
The market has changed so much over the last 3 years. It was super steady since like 2016, 15, just super steady. And the market through COVID changed so rapidly. And so that really confuses people. And so the question is, how does that impact people trying to get started or us trying to buy? And I think right now it's really 2 things. One, you have to adjust your underwriting. And so you have to adjust your underwriting. So for example, when COVID hit, all of a sudden we got lower LTV, bridge debt went away. We had to put a bunch of money in escrow for it. Well, that was new. Like, okay, well, I'm going to put that in my underwriting. All of a sudden I can't buy it for the same price anymore. Now the price is lower. Well, sellers are like, well, then go pound sand. All right. So you have to adjust your underwriting. Number one, and you have to know what's going on. You want to be you have to sharpen your pencil, but you also have to be realistic and conservative. Number two, especially when the markets are changing so quickly, I think the people who are doing deals, we did 2 deals after COVID, was to educate the seller and the broker in the process. Why can't you pay this much anymore? Well, let me tell you what changed in the underwriting. Let me show you the underwriting. And now this, in our opinion, has accelerated the seller coming down off their price. Like we're selling one right now, and in March, of course, was a high point, the highest prices in the history of prices. And we were wanting to sell, and so we are selling probably 20% below that price, which sounds like a really, really bad thing to do. But we have so much appreciation in the deal It's like an IRR of like 50% for the investors. It's ludicrous. And so why not sell, right? So there are sellers out there. I mean, not everybody, but there are sellers out there that if we educate them, if you as a buyer educate them about how your underwriting just changed because of what the Fed just did or here, that, I think your probability of getting a deal done is higher. But again, at the end of the day, while you change your underwriting, you don't compromise your criteria, right? You're still putting in margins for error. You're still trying to serve your investors, right? So you can't compromise your underwriting, if that makes any sense. You have to adjust your underwriting, but don't compromise it.
That's good. That's good. Yeah. And I've noticed too, we have seen some discounts at the register when we're coming to close, right? And we used to call it retrading, and now it's kind of not as bad a word as it used to be, right?
Well,
Say, hey,
it's still pretty bad.
yeah, it is. Yeah, it depends, I guess, who you talk to. I know we've talked about it before with Kenny on this panel. Buck, talk to us just for a minute. We're going to take some questions in a minute. So if people have any questions, there's a Q&A and there's the chat. If you could put it in the Q&A section, then we'll start going through and answering some questions. But I just wanted you to touch base on just really the impact of inflation that you see on real estate valuations. Again, is it inflation? Obviously, in general, things cost more. So rents are going up, costs are rising. That's obviously a plus side if you own real estate because it's causing things to go up. But with interest rates rising, do you think that if the Fed or if the government just continues to print more money, then it just continues to do valuations? Does that balance out valuations a little bit to where is it positive enough where it causes them to rise more? Or is it just that as rates rise, you can't really win that battle?
Well, I guess a good place to start is, what exactly is the Fed doing, right? The impact of rates don't rise in a vacuum. They rise because there's an attempt from the Fed to rein in on inflation. So remember, multifamily is, again, as I said earlier, one of the best hedges to inflation that exists because the leases typically are year to year. It allows for rent adjustments quickly. And I should point out, and I don't know, I'm curious on the other panelists' experience on this. We haven't seen a significant slowing at the level of the renters. Like, we're still raising rents, no problem, which is, again, suggestive of, well, okay, inflation's still a problem, so rates are probably going to still go up, right? But the impact on inflation on valuations, again, listen, the inflation and interest rates are intimately linked. Rates go up in response to inflation to curb inflation. Presumably, and if inflation is high, your rents are getting higher. And if you stay on top of operations, you might be okay. And so I think that's one thing. In terms of the valuations, of course, this goes back to what we've all been sort of talking about, is that there is a disconnect between buyers and sellers in general right now. In terms of the interest rates rising because of inflation, that's what's making it very difficult to find a deal that works, because the cap rates, although they may have slightly decompressed, they really have not decompressed probably what would be more appropriate, at least as of yet. So, yeah, that's what I would say.
Thanks, Buck. Appreciate that. We are getting some questions in here. I'm just going to start rattling through these. This is for Ken. How do you determine an exit cap rate when you're looking at properties in this environment? Is it in general 10 to 20 basis points per year, or how do you evaluate that in general?
That's a great question, actually. So I think, a couple things when you're raising it. If you're raising money and you're showing a lower cap rate, to Michael's point earlier, you could show anything you want. So we're not seeing lower cap rates. We're seeing cap rates gone up, at least in the last, many months. So what we've done is we're actually modeling it out a few different ways. So we're quarter, half, even a full point, just to see, of course, we won't know where they are. There's I think there's a couple things to with your sponsors too, is that if we're not really net sellers, as Bronson, we're really long-term holders. So I've owned properties for 15 plus years. I'm on my third value add on some of them. First I watched rates go down, each time, and made me look really good. And now they're going up a little bit more, but we just did a big cash out refi on a property in San Antonio, 680 units that I've owned for 10 plus years. And so, I look at things very differently than, trying to time a cap rate in years 3 or 4. These are long haul. We're trying to, and I think a lot of us are trying to provide that coupon, to the investor, that monthly, cash flow. And then when time's appropriate, then we'll go harvest that money. Taking chips off the table is good. Like Michael said, you don't lose money taking a profit. And so, you should be doing those kinds of things, whether it's a cash out refi or even a sale, maybe to a 1031 or something. But for us, we don't really have capital gain issues. So now, so if it's an IRR you're looking for, and that's typically institutional, very different than what we do. I'm more of a passive income, long-term cash flow guy. So we do pay attention to those, and we have to have them in our business plan. But we're often wrong, they're either higher or lower. So, but we do try. But I can tell you one thing: lenders and private equity guys are not allowing exit cap rates at lower than what you're buying. That's for sure. That does not exist.
I think a good rule of thumb is a 10 basis points per year, right? So for the five-year holder, 0.5% higher. I would be very cautious of investing with anyone who has a cap rate equal to or less than. That makes no sense. However, having said that, we did some sensitivity analysis on our last deal, and we said, hey, what if inflation and interest rates would go up in lockstep? 5, 6, 7, 8, 9, 10%. Now, of course, inflation, let's say rents go up by the same amount, but also your expenses, right? So they're not going up in a vacuum, and your interest rates are going up in lockstep. What we found was the IRR was exactly the same at every single level, right? And the reason is because your inflation is just driving up rents, but your costs are getting higher because of interest rates. So that gap apparently is being held exactly the same. So in that environment, the cap rate is going to stay the same because investors are getting the same return. Therefore, there's no reason to adjust the cap rate. Now, but what has happened, I'm not saying it's going to happen, is that the inflation and the rental growth has been much greater than the increase in interest rates. That's why the valuations have been so big over the last year specifically. Now, what's going to happen moving forward? I don't know. Are rents going to go up another 20%? Maybe, but maybe not. Maybe they only go up 10%. Okay, which is vastly higher than the 2.5% that we were using like 18 months ago for forecast rents.
It's true.
Meanwhile, so the rents are going up at 10%, and let's say interest rates are at an ungodly 7%. There's still a gap there, right? So if I'm looking at it from that perspective, I don't see cap rates moving at all. The reason they're down right now is because they ran up so much in March. People were like so frothy, and then the market corrected, right? And so anyway, so fundamentally, I don't think cap rates are going to move. Potentially, there's even an argument they can go down a little bit further. But to me, you want to project higher cap rates. It's just safer.
Thank you, Michael. Just a heads up for everybody getting some questions. This is being recorded and it will be sent out as a replay. If you signed up for it, it'll also be on YouTube. This is a follow-up. So we got Drew Niffen on here. Shout out to Drew Niffen. He's asking Buck, you mentioned that the Fed official or the former Fed official said that rates cannot go above 3.5% to 4%. Is that the Fed's fund rate, the 10-year Treasury, or SOFR? What was that in reference to?
That's the Fed rate.
Fed funds rate. Okay, great. And here's another question. This is just for anybody who wants to answer it. Do you think that lenders will potentially start loan modifications like they did for single family rentals in 2008 or even short sales? Do you see there being, I guess the question is there distress coming in single family or even in multifamily?
Well, I kind of think that distress is, I'm surprised we're not seeing more of it. I don't know what you guys think, but I mean, it seems to me that, the costs are going up, and there's a lot of people who got into the real estate game over the last couple of years that weren't necessarily putting in the work to create value. and really watching those properties closely. So I actually think that, there's a pretty good chance that we will start seeing some distressed sellers. And so, I mean, that's, I guess from a buying perspective, that's something to look forward to.
Thanks, Buck. This is from Christina. Christina Suter, please explain how you see cap rates moving as the cost of money is increased. Will they continue to compress because the housing shortage or real estate being a commodity, or will it decompress because of the sheer interest pressure?
I think we just talked about that, Bronson.
We just talked about it. Okay, got it. All right. Sorry, I'm just going through some of the questions. Let's talk a little bit about financing. What are some things that you're seeing changing in financing? Are you seeing, I think Ken, you had mentioned, obviously bridge debt. There's a lot of people in bridge debt. There are other alternatives, agency debt, maybe even HUD loans. Are you guys looking at other alternative debts beyond bridge debt?
Well, first of all, the number one driver for us is non-recourse. So that's the first thing. So
Yes.
if it goes to recourse, then we just say no. So that's just my own personal philosophy. I've seen market cycles take out people with recourse debt. So just from personal experience, I've seen that. So that's number one. So we are just in that box only. And I think, but there's a couple things on that cash out refi deal I mentioned earlier. The lender, after we got it all buttoned up and we figured out what we're going to do, they threw in two things. They threw in an interest rate reserve, which was very smart of them, I believe. So basically, they just said that we had to put so much on high ground for interest rates to hedge that bridge over time, but they held it, and a rental reserve in addition to our budget. They had a rental reserve. This is CBRE capital markets. So, so we're seeing that. And then on the stuff we're trying to buy, I don't know how about you guys, that we haven't actually talked about this yet, but, we're seeing 55% loan to values, that's it. And I mean, you can step out of those products and go with something different. But again, getting back to that recourse, non-recourse piece, I would rather have more equity on the deal and more reserves and than the risk without them.
Someone asking, I'm a college student. Is this a good time to get started in multifamily real estate, or what should I do to get started in real estate?
I have an opinion on that. It's never a great time to get started. Therefore, it's always a good time to get started, right? I mean, don't try to time the market. It's basically impossible. What I like about multifamily in general, which is why Kenny's still sitting up for 20 years, is that it's the best performing asset class, alongside with self-storage and mobile home parks in almost any market. It's super lucrative in up markets, and the downside is it performs very well in down markets as well. So if you like the strategy, then figure out how to get into that strategy. And like I said before, the only thing that's different, if the strategy stays the same, the only thing that's different is the underwriting, right? That's really the only difference. So figure out how you have to adjust your underwriting to get into a deal. And we talked about that really before. So that's kind of my advice. Time to get started is now.
That's right. There's that old Chinese proverb: the best time to plant a tree was 20 years ago. The second best time is today. So question here, somebody's asking specifically, I have 7 rental properties which are paid in full. Would it be a good idea to refinance some and go purchase other properties? What do you guys think about that? Owning properties out. I imagine these are single family or small multifamily. You own them outright with no loan. Is that a good idea or a terrible idea?
Well, I always think that, I'm of the philosophy, there's the Dave Ramsey court, which you shouldn't have any debt at all. I think it's, all of our whole portfolio. So we're right around 2 billion in assets right now, and we're right around 62% leveraged. So we're low, we're considered low leveraged. And I don't have it. Even during COVID, when everything got shut down, we took a look at our stress test, which is basically debt plus expenses. What's our break even occupancy? We're fine. And so I think there's a spot that you should be comfortable with. And if you can scoop that money out, fix it long-term, be happy with it, and you're cash flowing. The key is cash flowing. As long as you're cash flowing and you're happy with that, and then now you're just using what I call OPM, or other people's money. You're just borrowing from the bank off your own properties. But the key is, of course, making it work at more than what you're borrowing. So, it's a great way to harvest cash if that's the game you're in.
Right. That's great. I've also heard Russell Gray talk about this, that if you have a loan against a property, it makes it less attractive for it to get sued, or just that you have other creditors that would need that, and you can redeploy to be able to go after to more effectively redeploy your capital. I have a question here. Is it safer, or what do you prefer, or what are some, I guess, comparisons between a multifamily fund versus a single multifamily invested deal? So one property versus a fund of many multifamily properties. Who has an opinion on that? Then I'll jump in there at once.
I would just say that I think if you have a fund, which we don't do, we do individual assets, and I think it can be done well. I think Ken has, I think Ken has a fund, right? So I think the challenge, I think sometimes though for funds is there is an inherent inefficiency of capital. You've got to deploy the capital and you have to make a return on it. And so I think it sometimes, makes you buy things that you might not otherwise buy, or, just to try to hurry the process too much. So that's one of the reasons why I personally feel uncomfortable with it, because I don't think that would be something I'd be very good at. I like to focus on things that, you got one asset, how are we going to make this work and really maximize its performance? But that's my opinion. So.
Yeah, we of course have both. So my history has been one-offs, like Bucks, and what I found with the fund was a couple things. One, having that committed capital helps you when you're actually negotiating with the seller. So, you think about a seller and you're trying to buy a $75 million deal, and you're like, well, I have a fund and it's got committed capital in it, and I can close tomorrow, put debt on it later. I can, whatever, you have a lot of options. The other thing is, in ours, you could have 4 or 5 properties. So you might have one that's doing, let's say, 5% cash on cash, one that's doing 8, one that's doing 2, one that's doing 9. And so you get the blended, returns from all of those. And they're all, it's diversification inside of, one big fund. The negatives are the fees and some other things, of course. So we've done both and we've toyed around with both. We like both because it enables you to maybe stretch for something that you might have a big value add on that has a lower cash on cash. So you might pair it with one that's 8 or 9% cash on cash, as an example, and has a really good return. But you can stretch for something that maybe has an $800 or $900 rent lift in it. You might not see it for 2 or 3 years, but it'll eventually catch up. So it's been good for us, but it's I think with us, we're probably going to continue that way moving forward, just because it gives us those kinds of benefits.
All right. Thanks, guys. Okay, so we have Garrett Lynch in the house, another Nighthawk. We've got the whole Nighthawk team here, apparently. He's asking, what debt products do you like most right now on new acquisition and refinances?
Low rates.
Yeah, that's right. Whoever gives you the best rate, and it's non-recourse.
Yeah.
And, a little bit more leverage than 50%, maybe.
Yeah. They're really all very similar.
Yeah, we may have to hold it longer than we're used to with bridge,
Yeah. It's all pretty competitive, Bronson. It really is. I mean, we're doing a lot of interest only, products too, so you can do 3, 5, 7, even 10-year IO or interest only. You know, so there's all kinds of stuff you can do. And we try to pair it with the deal itself. And, you know, and then work backwards, you know, so I don't know, you guys probably do the same thing. You kind of take your deal, then you put the debt on it, and then you look at all the different kinds of debt, and some of them work well, some of them don't, and then you negotiate. Did we lose our host?
I think we lost our host. Kenny is now officially the.
That could be a first.
Yeah. We lost.
Oh,
There he is. He's back.
Oh,
is there a way to block
Okay.
him?
you just
Man,
moved
wait.
to the other side.
There's a way to block him. Yeah.
I gotta get my video back on here. Okay, all right. That's
It's like
a problem.
Stranger Things. You just went to the underworld.
Yeah,
You know when you
we're,
get booted out of your own webinar, that like, you know, that's a
I don't
problem
know.
there.
I have to learn how to do that.
That's like the ghost. That's what you do for dramatic effect when you're kind of
That's
wrapping up.
hilarious.
And actually, that's a perfect cue because we're getting ready to kind of wrap up. But I thought it was great. So, non-intentional, of course. But I want to thank each of you guys for being here. This was awesome. This is a great chat. Really, I think for a lot of people, getting value out of what do I do right now? How do I, you know, find a great deal? What sort of things should I look for in evaluating deals? Each of you, tremendous respect for each one of you for a lot of reasons. So just really appreciate each of you. I know a lot of people came from different, you know, they know Michael or they know Ken or they know Buck, but you should get on, follow each other. You guys are just awesome leaders in the group. So love that. We also have our investor club. We're doing our deals, like I mentioned, in Jacksonville, Florida, lots of stuff happening there. We opened our ATM machine fund this week. Exciting stuff. Wanted to share, we do webinars like this every month. So last month we had Harry Dent and Lizette Zhang and Jason Hartman. We had a big conversation about inflation. Next month on, I believe it's October 5th, we're going to have Russell Gray and a guy named Jay Martin, who's in the metal space, and I'm working on somebody else. So we're going to be doing that every month. Let's go around real quick and just why don't we just ask how people can follow you, or what's something that you're working on that people can connect with you on. Let's start with Buck.
Well, you have to follow up and tell me if Harry Dent still thinks that we're going to have deflation.
Oh, he did. You should go watch the replay. It was like there was like screaming and shouting on it between him and Lizette
That's
Zhang. It was
awesome.
really funny. Great.
So you know, where you can find me, I am a podcaster. I am an ex-surgeon. So a lot of people who are sort of high-paid professionals, who are interested in learning about personal finance, a little bit different than, you know, stocks, bonds, and mutual funds, certainly would welcome you to tune in. It's called Wealth Formula Podcast. And if you go to wealthformula.com, you can also learn more about me, and there's an accredited investor group there if you'd like to onboard as well.
Awesome. Thanks, Buck. Appreciate that. Michael, how can people get in touch with you?
Yeah, if you want to get started with syndications and you want to be active, we have some really cool downloads on maybe an ebook on how to raise money, how to analyze deals. If you're interested in passive investing, we have an FAQ on syndications. We introduce you to syndications as well. We have a passive income calculator. All those things are in our what we call our Freedom Vault, which is at themichaelblank.com/vault. And they're all in there. You can just download them for free. We've put everything in one place. And our investment firm is called Nighthawk Equity. So if you're interested in investing in syndications, we'd love to have a conversation with you. And yeah, we're at nighthawkequity.com.
Awesome. Thanks, Michael. Thanks for being here. Ken, how can people get in touch with you and follow you? And I know you're everywhere, but what's the best way people can connect?
Oh, thank you, Bronson. First of all, thanks for putting this together. So we have a podcast called the Real Estate Strategies with Ken McElroy, and it's doing very, very well. We're a couple 100,000 downloads a month. We've got a YouTube channel that we just passed 300,000. So that's been great. KenMcElroy.com leads you to everything. You know, we're just trying to educate. I'm trying to make sure that if people are raising capital, that, you know, that they're making money and they're making their investors money. So that's been my passion. Been in business 20 years, my partner and I, and it's a lot of fun.
That's awesome. Well, thanks for being here, Ken. Really appreciate you, Buck, Michael. Thanks to all of you that joining. This was great. I think all of us would say that the best investment you can make is in your own education. So having conversations like this with great people is awesome. And there's the saying by Jim Rohn, you're the average of the 5 people you spend the most time with. You spent time today with Ken McElroy, Buck Joffrey, Michael Blanc, and Bronson Hill. So anyway, everybody have a wonderful night. This replay will be sent out. It'll also be available on YouTube. We look forward to seeing everybody next month. And thanks, everybody.
Yeah. Thanks, guys.
Thanks, Bronson.
Thanks, guys.
Have a good
Thanks,
evening,
guys.
everybody.
Take care.
Bye, guys.
All right, see you guys.